Welcome to Easy Accounting for All. In this video, we are going to talk about general inventory concepts. And the concept that we are going to talk about is what is in inventory, importance of inventory in businesses, type of inventory evaluation methods, physical inventory systems, and inventory system versus general accounting records. So let's see what is an inventory. Inventory is what the company owns today, goods, material, parts, etc., in order to sell or use tomorrow. Also, the inventory is to sell, but also depending the company, they can use some of those inventories to either way produce something or to be consumed in the same company. There are other types of inventory, depending the size or how organized the company is. There are type of inventory like a office supplies inventory, or fixed access inventory, machinery and equipment, furniture, etc. In our accounting cycle course, exercise video 3, we create inventory as part of the learning process. This inventory will serve as the basis to explain the inventory reconciliation. So yeah, we create a fictitious company in video number 3. So the company name is Auto Maintenance and Parts, AMP. So we are going to use that those transactions to find how to explain the inventory. Importance of inventory in businesses. Generate income and revenue. That's the main goal. You buy inventory just to resell. So when you resell, you put in a certain profit there, increase the price, and so you get generate income. Ensure smooth operations. So you buy inventory because you want to have that handy for your customers, so you're supposed to have it at home, most of it. Support customer satisfaction. See if you have everything handy, so you can just respond quickly to the customer, so that provides certain satisfactions to the customer, and that's a good sign to move or to run the business. Control costs. Therefore, we need to know as much as accurate possible how much it costs whatever we sold, right? Because in that way you know if you are making profit or not, at least the gross profit. So that's very important to generate some information about the costs. Type of inventory. We have the raw material. This is the basic item used to create a product or service. So that means when you have the raw material is to create a new product. You don't have the final product. It could be those materials that you purchase, they are a final product for somebody else, for your vendors, but not for you. So that's most of the industries, manufacturing companies, they have that type of inventory. Work in process. It is an unfinished product or service. In our exercise, it will be a car in the repair process waiting for parts. That or rental service is in process. Finish is good. Okay, so these are parts that are ready for sale or use. In our exercise, it will be tires, oil, auto parts, and others. Obsolete or dead stock. Those are the items that are outdated or no longer in demand. Today's is very difficult to manage sometimes inventory because technology changed everything overnight. You buy certain amount of items expecting to sell, tomorrow is too late. Just those became obsolete, especially with the cell phones and many others. So that's why it's very important to have the right person managing the inventory with a good knowledge, with a good principle of inventory. So that person needs to know how to set up the maximum and minimum stock for those items in order to avoid to get to the obsolete other stock. Inventory valuation method. The reason to use inventory methods is to determine the cost of sales. The most common inventory valuation methods are first in, first out, also known as FIFO. Last in, first out, also known as LIFO. Average cost. I got to talk just about these three. There are more, but this is the most common methods. Based on the AMP inventory created during our accounting cycle exercise video 3, I'm going to play with these three methods. The reason why I'm going to play is just to show you exactly what the difference. Ahead of time, I'm going to tell you that in terms of the balances, it should be the same. Inventory balances, it should be the same from the inventory system and the accounting records. And we are going to discuss that one later. Physical inventory. A physical inventory is the process of accounting, measuring, or verifying all inventory items in a business to ensure that the record inventory in the books matches the actual stock on hand. Yeah, I say that it's a counting. So there are some items that is easy to count. So there are others that are not easy to count, so you have to measure it. And there's a different measuring type of systems, so you have to define exactly which one applies for your inventory. The purpose of physical inventory. Verify inventory records. Identify losses, theft, or damages. Identify obsolete or the stock we already went through. Adjust the inventory system and the accounting system records according with the physical inventory. Implement new inventory controls, establishing some promotions special for low inventory rotations. If you have the inventory, the physical inventory, all these things is going to help you to manage the inventory efficient, right? So you can just avoid to create obsolete inventory or their stock. You can just find out the ways that the inventory is missing or damaged. You can create controls for these things to avoid that this happen again. And therefore, you have to adjust your books, your inventory system and your accounting system. But the only thing that you're going to know that these things happen and measure it or count every single situation is just doing the physical inventory. Now, there are a few times that the computerized inventory system provides reports to you, but not necessarily for damage, not necessarily for identifying losses, but also to be aware about the identify obsolete and their stock, because the computer can provide you what are the items that have been moved in certain windows of time. So there are a few things that not necessarily you have to wait for the physical inventory. So anyway, inventory system, there are three basic systems. Perpetual inventory system. The inventory record or activity are updated continuously in real time. Usually this system uses back orders scanned through the inventory management software. Big companies use these ones. Also, if you go to the grocery store or the store by departments, most of the business today, they use the scanners. Just to put in there to chart the inventory or to discharge the inventory. To update the inventory with purchase or to just reduce the inventory with sales. So you can go to the grocery store, instead that they scan or you scan, depending if self-checkout, you scan the product, automatically just they're going to reduce the inventory. It's in real time. Nothing is 100% possible, but perpetual inventory system is one of the best ones that today's days is used for big and medium companies. Probably the small companies, the small business, no. Periodic inventory system. The inventory activity is updated at a specific interval like weekly, monthly, or yearly based on physical counts. I really recommend to do, if it's possible, weekly, but not later than monthly. Because you need to make correction during the year. It is not going to be a good idea just to wait 360 days to find out that your inventory has been damaged a lot, that to find out that you have already obsolete or dead stock, right? To find out that the inventory has missing records. No, it has to be as quickly as possible. So my recommendation is if you do weekly, at least monthly. And if you can do weekly, just by locations, because by the way, in inventory you have to have location where the part is storage. Yeah? Like an Excel row by columns. There is supposed to be locations where you can find the inventory. So it is good to have that one, if it's possible weekly by batches or at least monthly, as much as possible, hopefully hold inventory. Because we need to find out in real time, almost real time, what's going on, right, with the inventory. So don't wait too much. I don't recommend yearly at all. Hybrid system. This is the combined perpetual and periodical system. Often, tracking high value items perpetually and low value items periodically. Yeah. If you have very expensive parts, it is better to have perpetually. And the other ones, screws or something like that, something very small, probably you could use this periodically. So that's the combination between the hybrid, the combination perpetual and periodical. Okay. Inventory system versus general ledger accounting record reconciliations. In the ideal life, it should not be any discrepancies. If everybody works in a real time, doing the real situation that happened in a daily basis, it should not be discrepancies. But that's in the ideal life. But in the real life, it's always discrepancies. But the goal is just to find out why. That's the important thing. Why we had discrepancies. And there are several reasons why the inventory balance value had discrepancies compared with the accounting records, and specific with the inventory general ledger balance. So remember, when you do the comparisons, you just have to have your inventory balance, inventory valuation at a certain period of time or a certain date, and also you have to have your general inventory general ledger. So those are the main reports to compare. So your inventory report is say the value of my inventory at a certain day is this amount. My general ledger should have the same amount. But if it doesn't happen, we have to find out what of the following reasons applies or explain the discrepancy. Data entry errors. Of course, if you just make a mistake doing data entry, either way the person that is working in a inventory system, or if the system is not inventory system not integrated with accounting, and they just every single clerk just put different numbers for the same transaction, that create a discrepancy. And if the information is integrated between the inventory system and the accounting, but if somebody put just the wrong information, that's going to be transferred to accounting. It could be no discrepancies, but by the time that the accounting has to pay, probably they have to adjust the invoice or the transaction in accounting. They cannot just go back and adjust in the inventory. So if they pay the vendor, obviously they're going to pay whatever the invoice said, not the amount that was posted on the inventory system from the beginning that was transferred to accounting. So it is very important to have this clear. And if you have those ones, again, you have to reconcile the inventory accounts. Timing difference, very common this situation. Inventory system just put in a following month that's supposed to be, because they cannot redate the date in that system. It's very strictly system, so they have to put in the first day of the following month. In accounting, usually they are very flexible assistants, so the accounting just put in a right month. Either way, they integrate, but somebody just noticed that the invoice date is not in the right period, they just move it. It could be like that. So it's a timing difference. So that can create a discrepancy. System integration issues. I already mentioned very quick other things. It could be when the systems are integrated in between. So most of the time it's just inventory system supply the information to accounting system. But it could be in that transition, in that integration, when we try to upload the information from the inventory system into accounting system, it could be happen many things. It could be the integration just failed at some point and they don't transfer all the information. It could be they transfer everything, but at the end they don't pick all the information as well. So all those things create discrepancies. Unrecorded adjustments. It could be, especially this happens when it's a manual entry. Inventory direct, the inventory part just did the adjustment, but probably they don't report into accounting if it's manually. Or it could be, if it's an integration that I explained before, it could be in that integration the adjustment never transferred. So that creates discrepancies. Following up on the A&P inventory, we create in video 3 of the accounting cycle. I'll explain how inventory report works and how the data flows from the inventory system into the accounting records, especially the inventory general ledger. This is also a good opportunity to show that regardless of the inventory methods, there should not be major discrepancy between the records. Okay, I want to just mention in terms of reconciliation that each time that you find a discrepancy that the total amount, the total inventory from the inventory system report doesn't match the total inventory in your accounting system through especially the general ledger, so you have to do the reconciliations. And to do the reconciliation is basically just as I mentioned in my video about bank reconciliation, it has to be transaction by transaction. Purchases versus debits. Cost of sales versus credits in our accounting general ledger. So the process should be similar to the bank reconciliation. If you haven't watched the video for bank reconciliation, I highly recommend. I'm going to leave the link below in a few minutes, so you can just watch that one. The principles are the same. You need two reports, one from one system and the other one for the other system, and that's what we call internal reconciliations. So that's very important to keep in mind. Anyway, so now let's move to Excel because my exercise, I have been developed that one in Excel. Okay, this is the Excel. Just to refresh for a few of you, all these transactions came out from one of the fictitious company transactions that we create in my video number 3 for the accounting cycle course, video 1 to 4, and this is video number 3. So we create all the transactions for that time for the month of August. Also we create trial balance, the balance sheet. So now let's back to the inventory. So all these transactions are part of the monthly transaction that we create. So this is the purchases. So let me say something. Every single report looks different. I just create one that can be explain exactly how that looks. Regardless if you manually or the computer, it has to have this type of information. So we have the company name, we have the inventory valuation report, we have the month or exactly what day is this report. In this case, as of August 31st for any year. Okay. So this has to have the part number or SKU. The SKU is very usually for when they scan the products. The item name and the locations where the part is storage. Islands L116. So you have to create your own systems in terms of locations, in terms of SKU. Okay? So we had this activity here. We purchased 20. We had the beginning balance 0. We purchased 20 brake pads, right? The balance is 20 because 0 plus 20 is 20. So this is quantities only. So we receive in dollars $1,000 of inventory. So my beginning balance was 0, so my new balance is 1,000. So and the average cost per unit is $50. So we sold 2 units here, or we used 2 units. So we have 18 because 20 minus 2 is 18. And since we had the unit cost $50, 50 multiplied by 2 equal 100, and we have the new balance for my balance, for inventory balance for this item. So that's the way that the inventory looks like, and that's the way that your report at least has to have all these activities, all this information. Anyway, in here, technically we use just the average cost. That's what we use. Here we have the average cost, but I'm going to explain it in detail using just this item only, just to explain what the difference is in between methods. So that I say in the ideal life, it should not be any discrepancies, since we just, everything that we purchase here in our inventory system, it has to be transferred to our accounting system. It could be here is in detail by item, and here probably is just by invoice, right? But at the end, it should be the same dollar amount. Here we had 2,850 purchase, we had 2,850 purchase from our general ledger. This is what you need to reconcile, the general ledger. By the way, let me recap a little bit general ledger. We went through this one in my video number 3 in my accounting cycle course. So we need the account, which is the inventory of our parts, the period. In this case, we had to go through the full month. Okay, August 5th to August 31st. And this one is just up to this time. So they just provide all the activity. Or can be just also from August, depending how you go to review everything. But in terms of reconciliations, it should be from August 1st to 31st for that year. Okay? So here we have the date, the journal entry. We already went through the journal entries number, reference number, the invoices. This is part of your general ledger. And this is part of the activity, the transaction that I showed you before here, okay? So that's what it is. The descriptions. The general ledger has the balance. So if I calculate here my balance from the inventory evaluation report, it says that it's 2,220 and here it says 2,220. If that was the case always, you don't have to do anything. Everything is perfect. But in the real life, it's not. It's always different for all the situations that we explained and we listed before. It could be most of the time we had just a few cents of discrepancy here, so we had to adjust the cents. And it's easy just to adjust here than try to adjust in inventory. So this is the ideal situation, but I know that it's not going to happen always. But it doesn't happen just, again, you have to reconcile, you have to compare every single thing that is saved, this is part saved, and this is part used. So part received here in inventory is equivalent, or should be the same, total debits. And part used in here in inventory, it should be equal to the credits in accounting. Remember that we discussed about assets accounts, that we say the assets account increase with debits and decrease with credits. And also that the general ledger has a balance for every single line. And obviously at the end. So this is the way that's supposed to, but it never happens, so you have to find out, if you find any discrepancy, you have to reconcile. So let me show you how the inventory methods works. So we already talked about a little bit about the average cost, which is basically that you buy here, okay, and your balance, it is divided by the quantity balance. Your dollar balance amount, okay, you have to divide by the total units and you can just get the average cost. So we buy here for $1,000, we buy 20 units, so the average cost is 50. We sold one here or two, which is $100, but the average cost is still the same. In here, we purchased 5 units. The 5 units, each unit is $55 because 55 by 5 is 275. So when we added up the 275 to 900, they give me $1,175. But if I divide this one by the total units, my average cost became to 5109. So that's average cost. So at the end, if I just calculate how much was my average cost of sale based on this method, is $355.43. That's the way that the average cost works. Now let's go to LIFO. So LIFO is last in, first out. That means either way we just purchase 50 here, right? So we sold here, we don't have any other purchases, we just sold 2 here at the original average cost here. But at some point we purchased 5 here, which is 275, and we say the average cost or the cost is 55 per unit. So that's my last purchase. So according with these ones, if I sold one more item, forget about it. If it is the item that we purchased part of the 820, so it's just the next item. You had to sold that item based on this cost. So we sold here 4. So that 4, instead of just came out for $50, which is the average cost, as we did it here, right? Instead of came out 55, sorry, at 50, they came out at 55 because that was the last purchase that we did it. So 4 by 55 equal to 120. If we sold the next one, I just tried to match this number, but if we sold this one, it has to be at $55. I just put 4 plus 1, 5, 5. So at this point, we already sold the last purchase inventory. So that means if I sold one more item, that's going to be out this inventory by $50. So one thing that I want to point here is about the cost of sales. My cost of sale in average cost here was $355.43, and here for the same item, same activity, is $375. That's one of the big difference. Okay. Now let's go back, or let's go to FIFO. FIFO is first in, first out. If that means we purchased 20 here, that's our first purchase. So we had to sell all the first items for the original cost for that first purchase. So we sold here 2, so that has to be for $50. Okay, so we had to make sure that we had to sell all the first units that we purchased. So we had 20 here, we sold 2 here, we sold 4 here, and 1 here. So we had 2, 6, 7 units. Those sales should be based on the beginning cost. So that means that our cost is based on the first units that came in, and that's going to be the first one that we are going to take it out from the inventory. So we have 7 units here, right, that was sold at $50. Either way, as I explained, and I left here that information, we purchased a few here that the average cost is 55. So at this point, from the 20, we sold 7. That means that we have 13 from the 20 that has to be sold at $50. And when we finish with that part, we had to use the next purchase at the $55. So let's face this one. So average cost give me $355.43 cost of sale for the same quantity, same unit, same items. LIFO $375 and FIFO $350. So most of these systems are used for companies just in terms of depending which one is more favorable, is more good, is better for taxes. Right? So that's the main discrepancy. But in terms of the information from here to accounting, if I had to record my cost of sale, is this one? Or this one? Or this one, depending what system they are using in inventory system. So that's what I have for inventory. I hope this helps to understand more about some concepts, inventory concepts. So that's what we did. Okay, that concludes our section on basic inventory concepts. Inventory is a broad and important topic, but in this video I have covered some fundamental ideas that I hope will help improve your understanding. If you haven't already, please make sure to subscribe so you don't miss future lessons. Below you will find links to related topics including the accounting cycle and bank reconciliation. More videos will be coming soon. Again, bank reconciliation I just put in here because if you need to reconcile the inventory between an internal reconciliation between inventory system and accounting records, you can just follow the instructions that I just placed in my video for bank reconciliation because the main concepts are the same. The main principles are the same. So in terms of the procedures. Okay, thank you very much. I hope you enjoyed this video. Hopefully I will hear from you and enjoy. Thank you very much. Have a nice one.